Well, far away from the well-known metropolis and covered by the seemingly endless Amazon rainforest lies the state of Pará in North Brazil. And that's where you'll find the operations of Serabi Gold, a company based in the United Kingdom. Well, it's a pleasure to have Serabi CEO Mike Hodgson with me. Mike, thanks very much for joining us.
Pleasure to be with you. Thank you for the invitation.
Well, presumably busy days for you. I understand you just returned from that site in Brazil. Give us a bit of a background to Serabi and what it's doing there.
Okay, well, we've been around for quite a long time in that part of the world. We opened a mine called Palito in way back, well before my time, in the early 2000s, and the mine operated quite successfully for about 6 or 7 years. Kind of lost its way in sort of 2007, 2008, chasing scale that really wasn't there, and the mine then went into it. Kind of coincided with the GFC, and the mine closed. I'm kind of associated with the restart, which happened in 2013. We reopened the mine with buoyant gold prices, and since that time Palito's been a steady sort of 30 to 35,000 ounce producer, nearly 40,000 ounces 1 year. And I guess we were a single asset company kind of existing and just generating a little bit of money just to sort of do a little bit of exploration. But I think the real step change for us has come in 2018 when we purchased the Kinga Mine or Kinga project, I should say, from Rospiti's Anfield Gold. They'd done a lot of work there and really advanced this project, and it very much looked like another Palito, another high grade 50,000 ounce a year mine underground opportunity. Too small for them, but a good fit for us. So we acquired it. We've been working our way through the permitting stage, and pleased to say we're putting the mine. We've been in development now for a couple of years. We're just about putting it into production now, and what it means for us is a doubling of our ounces. We'll be going from 40,000 to about 60, 70,000 ounces in the next 2 years. So still quite small, but certainly these gold prices going to be generating a lot of very good positive cash flow.
And I want to talk about Kinga in a moment. But as with any mine, Mike, the basic goal would be to increase production, improve profitability. What's your strategy like in that context in the long to medium term?
Well, our costs are fairly fixed. We've got both of our mine sites are camps, so people don't really go home at night. So we obviously always have a fairly large fixed cost labor component. So the game is always about more ounces, and our costs won't really go up. So at the moment, we're producing about 40,000 ounces this year. We'll do nearly best part of 50,000 ounces next year, and hopefully 60 the year after, without any real labor cost increase. So our AISC is going to come down quite considerably from the sort of the 1700s at the moment to hopefully around sort of the high 14 or the 1400s by the time we've got to 60,000 ounces. So we are just literally spreading our costs over more ounces. So no real cost increase, but a very big, healthy increase in revenue and therefore profit margins. And I think it's fair to say with every 10,000 ounce increase in our annual production, our AISC comes down about $100 an ounce. So it's that's the game. We will never be the lowest cost producer because we are underground, but we are high grade, so we do focus very much on moving small volumes of material and delivering the highest quality product to the process plant. That's quality counts. That's our motto.
All right, so two sites, and you touched on it a little earlier, but the more established Palito complex, as you say, which from what you say has been churning out some favorable production. But then again, I see a lot of enthusiasm for the newer Kinga site, which is, as we said before, transitioning from development to production. The focus there at the moment, Mike, what is it?
Well, Kinga is you're correct. I mean, Palito is a very decent ore body. It's been a very good servant for us, and it's actually had some very good grades. But our ability to convert inferred resources to reserves at Palito, we have to work quite hard to find our reserves at Palito. The ore bodies are quite erratic, quite poddy, and we have to do a lot of development, and a lot of that development ends up not being economic. So that's it. Kinga is a dream. It's a Rolls Royce in comparison. We've got into underground at Kinga, and our conversion of inferred resources to reserves is about 90%. It is far more grade continuous, far more structurally continuous, far more geologically continuous. It's higher grade. And the amazing thing about Kinga is it has this great amenability to a technology that we're championing called ore sorting. And what we're doing is we ore sort at Palito. We have an ore sorter, and what an ore sorter does is not really greatly used in the gold industry. It's more used in the diamond industry and probably in the agriculture industry. Ore sorting can actually separate on either color or on density, and particularly in the case of Kinga, the ore is hosted in sulfides in very white veins, and the waste rock is red. So if you can separate the white from the red, you are getting rid of the waste. So what we actually do at Kinga is we mine the ore out of the ground. We get inevitable dilution with it, but before it gets transported to Palito, we can actually put it through an ore sorter where we can separate the waste out, and we can then essentially pre-concentrate the ore before it goes on the trucks to Palito. What this has done for us is it's allowed us to actually, when we bought Kinga, we were fully committed to thinking, well, Palito is its own mine with its own process plant. Kinga is going to be a second mine with its own process plant. So there wasn't going to be a great advantage in reducing AISC because of it was essentially there wasn't really a great amount of operational synergy apart from management synergy.
Yep.
The ore sorting has obviously changed that. When we bought the asset, the road between the two mine sites was not a paved road, so it's physically difficult to connect the two deposits together. Secondly, the trucking cost was pretty expensive. And thirdly, the cost of trucking what was going to be a 7-gram ore body at Kinga to Palito was going to cost about 3 grams, so economically it just didn't make sense. But once we got underground at Kinga and we saw actually ore sorting would work incredibly well. And what does ore sorting do? Well, the ore comes out the ground at 6 grams. By the time it's gone through the ore sorter, we have halved the volume by removing the waste and doubled the grade up to 12 grams. So all of a sudden, you've got a 12-gram product. Now, the trucking cost has come down with the paving of the road. There's now only half a gram. So the economics are there clear to see. We don't need to build a $40 million process plant at Kinga. We can actually put this ore on the trucks at 10, 12 grams per ton. It's going to cost us 0.3, half a gram per ton to truck it to Palito. So it arrives at Palito 11 grams per ton or more. So it's a very nice, very cheap, not a great OPEX because we're not trucking huge amount of volumes, but we're trucking really high quality product, and we don't need to build a process plant in the process.
And it does lead or flow quite nicely to my next question, because ultimately you've got to talk about the cost of producing gold, right? Of course, an obvious metric gauge for profitability when it comes to investors. And you touched on it. You've gotten all-in sustaining costs standing at about, just under $1,800 an ounce at the moment. As
Correct.
you get that production up, I mean, do you see that cost dropping? That's an important point for investors, isn't
it? Absolutely, yeah. Now, what we'll do, as I said to you before, our costs are pretty flat every year, every month, because they're fixed costs. We've got costs of about $6 million per month. And we're going to, so if you do, and our costs aren't really going to go up as we ramp up from 40,000 ounces or 38,000 ounces this year, high 40s next year, 60,000 ounces in 2026. Our costs are not really going to go up very much, but the ounces clearly are. And it's just simple maths. We'll be spreading, those costs over sort of instead of actually having for 38,000 ounces next year, we'll have 46, 47. The year after, be 60. So what that actually means is the AISC, which is currently in the high 17s, will come down to the sort of the mid 15s next year, at the end of next year, and we would hope by the time we're doing 60,000 ounces, we'll be in the low 14s or the 14s at least. So wherever you want to put the gold price, that's going to be a heck of a margin.
Yeah. The other thing is growing cash balance. I mean, what you don't want to do is start making these expansions on debt, right? You've got to use that growing cash balance to good source. What's happening on that front? What's the plan?
Well, we've enjoyed a great year. We have done all the capital. We're going to do. We've got capital growth underground development at Kinga next year, but basically all the big capital has now been spent. We built the crushing plant at Kinga this year. We've installed the second its own independent ore sorter. So there's no process capital going to be spent anywhere now. So we actually forecasted that this time last year, our guidance for 2024 was 38,000 ounces. We're going to basically make 38,000 ounces. We did forecast ending the year with about $8 million in the bank. We're going to end the year probably between $20 and $22 million in the bank. So that's a heck of a lot more than we planned. That's down to obviously a very good gold price, but it's also down to a very favorable exchange rate between the Brazilian real and the US dollar, because our costs are largely in reais, and the reais actually ended up being nearly 6 reais to a dollar now, and we budgeted 4.7 or 4.9, sorry. So that's obviously been a huge help to us as well. Next year, using very conservative metrics, we would expect to generate another $15-20 million free cash flow next year, even after all of our capex. So we are saying we end the year with 20 million in the bank. We're going to grow another 20 million, say, next year. We're going to be building a nice treasury.
But there has to be some alignment between the resources needed or available and that which is needed to achieve 100,000 ounces of annual production at Kinga. What's the alignment like there? Are you confident that there's a potential to identify the resources needed to achieve that annual production?
Well, the reason we're sort of capped at 60,000 ounces going, so the phase one is to basically ramp our production up to 60,000 ounces. It stops at 60 because that's when our current process plant is actually at capacity. We can't squeeze any more through our process plant anymore. We're getting more ounces through our existing plant by increasing the grade, not by increasing the capacity. The capacity is staying the same. We're just actually high grading to get the grade up using ore sorting. To go from 60 to 100 and to expand that process plant, we do need to do brownfield exploration and resource growth. We've got two properties, Kinga and Palito. They're both 500,000 ounces each, so group ounces, 1 million ounces. We both feel there's very strong upside to actually grow the resources at both sites. So next year we're going to be spending, we're discussing this right now, but we're probably going to be spending in the region of between $6 and $8 million next year on brownfield exploration, with a very purpose to actually move our resources from 1 million ounces to initially 1.5 and then threatening 2 million ounces. And with that resource growth, we are going to be able to talk about expanding the process plant and pushing on to 100,000 ounces instead of 60,000 ounces.
Mike, as we wrap up, you're in a very environmentally sensitive area. That's a very sensitive part of not just Brazil, but the world. What's your carbon footprint like? How's the company approaching that?
Well, it's about as good as it can be. We are underground mining, so our footprint's tiny. First of all, we're not cutting down mobs and mobs of trees. We actually don't cut down any trees at all, literally. We are so very small footprint in that sense. We're on the grid on our main mine, Palito, and the process plant, and then we've got a new line coming in as I speak. That's all hydro. So we've got hydro. So if you look at our metrics, tons of carbon dioxide per ounce of gold produced, we're 0.42. We're right at the bottom end of the spectrum. There's virtually no company that's generating an ounce of gold with a lower carbon footprint or lower production of CO2 emissions than us. So that's great. And that's going to get better because we're obviously going to connect Kinga to the grid fairly soon. So we're going to have both mines operating on hydro power. Very small footprints, and as I say, generating a quality product rather than moving huge amounts of rock. Big advantage of underground mining, that you have a very small footprint.
Yeah, and in closing, I've got to ask you, I mean, what should an investor, or why should an investor consider owning a Serabi share as I leave you?
Well, our share price, if you look at all the metrics for us, we are still very undervalued. I mean, I sit there looking, we've got a share price of nearly $100 million today. 20% of that's in cash. That kind of shows how undervalued we actually are. We've got all this upside to come. We've got obviously we've got a very clear pathway to 60,000 ounces. That's almost given. So I think this time next year our share price should be double what it is today. So it's a great opportunity. We've come from 23p to a pound in a year and a half. Certainly we're not done yet. We've got a fair bit of runway still to go.
All right, Serabi CEO Mike Hodgson, thanks very much indeed for talking to me.
Pleasure. Thank you very much.